Hey everyone, and welcome back to the Rate of Return podcast, a 30-minute podcast whose entire purpose is to equip you with the tools and resources to become the best financial version of yourself. From investing in the stock market or real estate to cleaning up your personal finances, putting you on track to become a millionaire, the Rate of Return podcast exists to give you actionable insights you can work toward today. In light of tax season, I thought it would be a great idea to bring on an absolute tax expert. Eric Bronnenkant has over 20 years of tax and financial planning experience across Fidelity, Ernst & Young, and now Betterment. He's a certified public accountant, a certified financial planner, and holds his, here you go, ready? Series 7, 9, 10, 24, 27, and 63 from FINRA, a lot. As it relates to formal education, he has a master's in taxation, another master's in accounting, and another master's degree in quantitative finance. He's a contributing author to Ernst & Young's Tax Guide and frequently speaks toward confusing tax-related topics as published by The Washington Post, Bloomberg, Forbes, USA Today, and CNBC. Eric, thank you so much for joining us. And before we jump into the all-encompassing tax questions that we have prepped here, did I miss anything when introducing you? I feel like your background is so robust.
Austin, I'm honored to be here. I think about all the things that I've done over the last 20 years, and you did a pretty amazing job at highlighting some of those, many of those things. And sometimes I don't always, keep track on a daily basis of exactly what I've, kind of looking at it on that, 20-year time horizon. And now just kind of you talking about it was giving me another chance to reflect, be like, oh, wow, I've done a lot over the last 20 years. So I'm super excited to be here and be able to, share my experiences, with you and, the guests.
100%. Thanks again for joining us, man. So for those who are listening right now, let's make it very easy, right? We're going to break this discussion down into themes, with the first theme being stocks and investments. We all know taxes are intimately woven into the entire decision-making process when it comes to cashing out on our investments. And 2021 was a year a lot of people found themselves actually making these types of decisions. A lot of folks opened their first online brokerage accounts last year. Others found themselves using robo-advisors like Betterment. What would you say, Eric, to the first-time investor prepping their tax return right now as it relates to stocks and investments? Is there anything in particular they should be looking out for?
Well, the first thing they should be thinking about is, am I getting a tax form, or should I be getting a tax form for the investments that I had in 2021? If you have any investment sales, those go on a tax form 1099-B. If you received any dividends on stocks, those go on a 1099-DIV. And it's common for people who may not have been participating in the stock market previously, to be unaware that they're going to get additional tax forms. But the IRS, their goal is to keep as much of the income that people get under some sort of reporting process. They use what's called document matching. So like you get a W-2 from your job, and so a copy of that goes from to your employer, to the IRS, and a copy goes to you. And so that kind of keeps you in check. So when you file your taxes, you can't understate your income very easily without the IRS. The IRS already knows how much money that you make. And the same is true for your investments. The IRS already has most, if not all, that information. And it also helps you prepare your taxes easier also.
So it sounds like for those people who might have made those first investments this last year, to be looking out for any tax forms from their online broker, if that's a robo-advisor like Betterment, if that's an online broker specifically for single stock trading, perhaps like Fidelity or maybe a public.com. But regardless of who they use, they need to be looking out for these tax forms.
That is correct. And now one of the most efficient ways that people can get that information into their tax return is using an import process. Tax software companies like TurboTax, Tax Act, H&R Block, some of the most common ones, they have the ability to accept data directly from those brokers, and that makes investor lives much easier instead of having to retype that information in on their own. So being able to import is a great process and should be used whenever possible.
Got it. Got it. And what about the person who might have lost some money last year? What about the guy who YOLO'd his investments
Mm-hmm.
on the triple leveraged ETFs that exist, right? And he lost $6,000. He's kind of down. He's feeling it right now. What would you say to those people? Are they going to see any sort of specific tax, things to look out for?
Sure. When you sell investments at a loss, and this is only when you sell them,
Hmm.
in general, you're able to use that loss against other gains that you have, and then up to 3,000 against other income. So that loss may provide you some valuable tax benefits by helping you, minimize your taxes. Now, and if you have any additional losses, then you're able to carry those forward every year until you use them or you die. So you can just kind of keep rolling those forward. So just if you don't use all of your losses in the current year, then you may be able to use them in future years. Now, a new concept that many investors struggle with at the beginning is the concept of wash sales. The IRS says that if you sell an investment at a loss and then you buy back something that's substantially identical within 30 days before or after the sale at a loss, you're not able to take that loss currently, as you are required to defer it or kind of push it forward until you sell your replacement position. The whole point is that you're not able to take losses where you basically buy back a similar or a substantially identical investment, and you basically have the same economic exposure. You can't sell losses for tax benefit's sake alone.
Got it. And I think I read somewhere online that cryptocurrencies aren't, I guess they don't fall into that wash sale category just yet. I think it's kind of loose right now. So like, what about crypto taxes? I feel like a lot of people bought and sold crypto last year, and maybe some did this wash sale strategy. Is that a thing?
A great question. So the IRS decided that crypto was exempt from wash sales because they classified it as property and not as stock or securities.
Hmm.
And so the normal rules that would apply to like stocks, bonds, mutual funds, ETFs, and things like that for wash sales actually don't currently apply to crypto. However, one of the proposals in the Build Back Better plan, which hasn't passed as of the moment, is to bring cryptocurrency under the wash sale regulations. Is it possible that might happen in the future? It's possible, but where the exact legislation will land, if it will get passed and in what form, are all areas of uncertainty.
Got it. Got it. Okay. So what I'm hearing is keep an eye out for tax forms from your online broker, and if you sold at a loss, maybe that could be some sort of benefit going forward. And but don't consider selling at a loss just to buy it back because they already thought about that. That's called wash sales, and that's actually not a thing. So
On
sounds
crypto,
good.
the wash sales aren't
Except
right.
crypto, yeah, crypto is still a
Right. So
thing.
on crypto, you can sell and buy back immediately and not have a wash sale. So the law under that is that you can kind of continue to do that, whereas on the stocks, bonds, mutual funds, ETFs, those are subject to wash sales.
Got it. Got it. So the next theme I wanted to talk through now were small businesses and side hustles. I'm not sure about you or the people listening, but I've always been about hustling something on the side, and I don't think I'm in the minority here, right? So, do you mind talking through the type of benefits that folks with side hustles and small businesses receive from a tax perspective? Like talk me through incorporations and why someone would want to incorporate their business or what that looks like.
Sure. I love the ambition and the spirit and the entrepreneurial spirit of Americans overall. And so these are some of the most common types of questions I get are about setting up an LLC, or some other type of business entity, or they just want to provide some other business services on the side from their regular job, whether it's tax preparation, designing code for software. There are so many different opportunities for side hustles out there, or even on the more common side, like things like Uber and Lyft. Those are other examples. So kind of the most common business structure is actually no structure at all, and that's called a sole proprietor. And basically, you and your business are the same for tax purposes, and all the income, all the profits from your business are taxed on your personal income tax return. And now there are some other types of business structures. There's what's called a partnership, an S corporation. Those are also known as pass-through business entities, where the income is also taxed on the shareholder investor's personal return. And then on top of that, there is a C corporation, which is subject to 2 layers of taxation, once at the business level, and then again at the shareholder level when dividends are paid out. So that was a very brief intro into some of the different types of structures. Why do some people choose one or the other? Well, in general, people do prefer a single level of taxation because that it's only taxed once. However, there have been some changes in the tax law that happened as part of the Tax Cuts and Jobs Act, otherwise known as TCJA. And back in 2017, the corporations, their corporate tax rate was reduced from 35% down to 21%. So that became a more attractive option. Also, pass-through business entities, some of them are eligible for what's called a QBI deduction, where you get an extra 20% bonus deduction on top of all of your other business expenses, as a way to keep everyone from kind of jumping into the corporate 21% tax rate, and trying to find some balance between those two.
Got it. Sounds good. No, I totally understand. And personally, I think I do a S corp. I need to ask my accountant about that, but I'm pretty sure that's what I do. And so let's say that there is someone out there, right, that has maybe it's a car detailing side hustle. Maybe they have a pickup truck, and they've got buckets, and they've got soaps and scrubbers and all these other detailing equipment inside their truck bed, and call it 4 to 5 times throughout every weekend. They go around town detailing people's cars in their own driveways, right? So they'll drive to someone's neighborhood, detail the car, and they make money that way. How I understand it is that if you are doing that, the buckets, the scrubbers, the soaps, those are all tax deductible, right, as an expense. Is that correct?
That's correct. Expenses that you incur in the production of your business income are tax deductible. Like your examples of the buckets and the scrubbers and things like that. The truck itself is a little bit more complicated, and the fact that most likely you're using that truck for something other than business purposes all the time. You're probably using it for personal purposes to, let's say, get to your regular job. And then are using it sometimes for business purposes. So some of the expenses related, let's say a portion of the expenses related to the truck may be tax deductible. The ones that are really attributable to the business portion and kind of overall expenses for the truck that you may have to use some sort of prorating method to figure out the portion of deductible expenses there.
Got it. Okay. So any sort of expense you incur as it directly relates to the production of your sort of good or service can be written off. And if you have that maybe detailing side hustle, or maybe it's you are amazing at making unique phone cases out of wood, right? Maybe the solder gun you use, or maybe the markers and paints that you paint those phone cases with, those are direct expenses.
Right.
Got it.
Absolutely. And one of the good things is that the IRS doesn't designate exactly what is an allowed expense versus not. I mean, there are some things they specifically say are no-nos, but in general, it's about, what did you incur that expense as part of your the production of that income? Was it an ordinary and necessary business expense? And that's kind of the driving theme in determining whether or not it's eligible for a tax deduction.
Got it. And now let's talk about, let's say someone's got this side hustle and they're making money, right? They're clearing tens of thousands, if not hundreds of thousands of dollars doing it. It is a business now. Maybe they're doing it no longer as a side hustle. It's their thing, but they're still not big enough to say that there's some, enterprise. It's maybe them and a couple friends. But, talk to me about investing within a small business. I know a recent growth lever that Sarah Levy talked about was launching the 401k contributions for small businesses with Betterment. How should folks be thinking about investing while also running their business?
I think your question is about like setting up a retirement plan for the small business, and there are a few different options. One of the most common ones is a SEP IRA. In general, you're able to contribute 20% of your net business profits. That's your business income minus your business expenses, minus one half of your self-employment tax. You can do that up to $61,000. And this is a plan that doesn't require any special forms or really any. It's very light on regulatory requirements. One of the things that you do need to do is that you do need to provide the same percentage that goes into your SEP as an owner as your employees. So, so there are limitations. So if you don't have any employees, well, then it's very easy to say, all right, well, 20% of my net business income up to that 61,000. But the decisions get a little bit more complicated when you also need to contribute into your employees' plans. And this is why some companies also have to think about, all right, well, do I want to hire someone as an employee or do I want to hire them as an independent contractor? Because if I hire them as an independent contractor, then I don't need to provide them any retirement contributions if I'm contributing to my plan, because they don't really work for my company. They're their own company.
Got it. And can someone have a SEP IRA while also having a Roth IRA?
Great question. Yes, you can have a SEP IRA on top of having a Roth IRA, assuming you meet the income limits for a Roth IRA. But there's nothing that would prevent you from having both. So let's say your 20% of your net business income is let's say $20,000. So because you had net business income of 100,000, well, then you'd be able to do 20,000 to the SEP, and then you could do another $6,000 into your Roth IRA on top of that SEP contribution.
Got it. Okay. Makes sense to me. I hope it's making sense to folks listening right now as well. In the middle of asking these fun and just riveting tax questions that I'm sure everyone's just loving to hear, which I think is pretty interesting. But in the middle of our podcast, we have a little, halftime show called Mailbox Money, where we take questions from the audience. As you know, I've got a Substack account, almost 6,000 people tune in over there and read our emails and our content. And we had tons of questions in anticipation for this podcast. So we picked 3. And we're going to share them with you now. So the first one is Tyus from Colorado asks, I'm a college sophomore and I'm wondering if there's anything specific you'd suggest reading or studying if I want to be good with my taxes in the future.
Well, I thought about this question, and because I got it a number of times over the years, I can't say that there's one book that's kind of across the board great to learn about taxes. There are a number of books that have that are kind of more specific. And one of my favorite books is called Go Roth, and it's all about Roth IRAs. I mean, you've already touched on this. Roth IRAs are a powerful retirement savings vehicle where you're able to save after-tax money today. And in general, you get tax-free income in retirement. The government does not get to share and share in your investment returns. So all the good decisions that you make in your Roth, the government doesn't benefit from those. So that's a huge win. So learning about how you can leverage the Roth as much as possible is a great strategy. And a book that I've read a number of times is called Go Roth.
I love
It's
it.
written by a Harvard tax lawyer named Kay Thomas. So.
Very
Mm-hmm.
cool. Very cool. There's your answer. Next up is Lindsay from Washington State. She says, I'm new to motherhood. What should I be aware of for parenting tax tips?
Well, for 2021, there was an expansion of the child tax credit. Some people, depending on the age of their children and how much money they make, could potentially get a child tax credit up to $3,600 per child. So,
Wow.
for some people, if they have 2 or 3 children, that could approach 3 children, you're approaching $10,000 worth of tax credits.
Mhm.
And then on top of that, there are also tax benefits for dependent care. So if you're paying for someone else to watch your child so that you can go to work, then you may be eligible for a tax break either through your employer or getting some tax credits on your tax return. So I guess the first two things that came to my mind are the child tax credit and the child and dependent care credit, as these are things tax breaks for parents. That now is everyone going to receive those? Not necessarily. In general, the more money that you make, the less tax breaks that you get. That's just kind of a general
Mhm.
rule of taxation. But I would
Mhm.
argue for someone who's a new parent, they're more likely to be eligible for those types of breaks.
Got it. Got it. I love those answers. I don't have any children of my own, but if I did, I would be taking
Mm-hmm.
advantage of those. Finally, our question comes from a Jeremy. Jeremy from North Carolina. He says, "Would you say?" And this is actually really
Mm-hmm.
interesting. Like I saw this question, I was like, I got to
Yeah.
include this. He said, "Would you say that beating on taxes is easier than beating the market?"
I would agree with him. I think I'm going to reframe his question a little bit. Uh,
Hmm.
you know, uh, it is commonly understood that it is challenging to outperform the stock market, and that's why
Hmm.
many
Hmm.
people invest in index funds, recognizing the challenges of stock picking and being able to consistently do that over long periods of time is very difficult. There are many academic studies that support that. However, one way to provide what we call tax alpha, or basically extra return, is based on taxes, and that's why people focus on things they can control, and one of those is taxes. So using things like tax loss harvesting or tax coordinated portfolio, otherwise known as asset location. These are areas where people do have more control over, and if they understand how the tax laws worked, they can boost their after tax returns by being more tax efficient.
I have never in my life heard of tax alpha. That is so freaking cool. Nice. Okay, I now have
Mhm.
homework. I love it. I love it. This is our last
Mhm.
theme. Right, we talked about stocks, we talked about side hustles. Let's talk about something really hot right now, home buying, right? If I'm not mistaken, buying and selling a home are major, events that impact your taxes, and considering we saw a massive influx of people buying their first home, I'd imagine a lot of people are also selling that home, right? Buying and selling. It's right. So this is a subject worth diving into. Let's break this down into buying and selling. Sort of different questions here. Starting with the buying side, what tax implications do people experience when buying a home?
Great question. The first thing that someone would want to be thinking about is the kind of the two main tax breaks of home ownership, which are mortgage interest and property tax. Uh, so now to step back for a moment, though, not everyone is going to receive a benefit from paying for these items. For one reason is that the standard deduction for a single person is around approximately $12,500, and for a married couple is about $25,000. So to be able to benefit from the property tax and the mortgage interest that you pay, your itemized deductions have to be greater than your standard deduction. So for a good portion of America, their standard deduction is greater than their itemized deductions, even if they do own a home. Now, if you live in New York, New Jersey, Maryland, California, Massachusetts, places that have higher cost of living and have higher home values where they've had to borrow more money, then in those areas they have an increased possibility of being able to itemize and get themselves over that standard deduction threshold.
Got it. Okay. And then what about, so let's now flip to the other side of the aisle. What about selling a home, right? What are the tax implications people experience when selling a home?
Great question. The IRS has something called the home sale exclusion. And if you've owned and lived in your home for at least 2 out of the last 5 years, you may be able to exclude up to $250,000 of the profit as a single person, or up to $500,000 of profit as a married couple. So it is common for many people to actually not pay any taxes on the gain when they sell their main home. So this is only for your primary residence. It doesn't apply to let's say you had a home that you used as a rental property all the time and you never lived there. Well, then you can't use the home sale exclusion for it. So this is for strictly for your primary residence, where you get the most amount of subsidies in the system.
So what about, now this is just for clarification, let's say that let's say that Jim and Pam, right, off the office, let's say Jim and Pam were living together, they had a house and they were loaded. The house that they bought was worth $1 million when they bought it in 2010. And they're selling it this year, 12 years later, for $3 million, netting them, let's assume closing costs and all those things aren't a thing, but let's say they're netting $2 million in profits. Being married, are you saying that with this exclusion, they would be able to only pay taxes on that $1.5 million?
That's correct. So you would only pay tax on the profit after the home sale exclusion. So if your profit before the exclusion is $2 million and you were able to use $500,000, then you'd have a $1.5 million long-term capital gain, because that's an investment that you held over a year, and that's taxed basically like a stock that you held for over a year. Same long-term capital gains tax rates. Except stocks don't have any home sale exclusion. That the home sale exclusion is just for your primary residence.
Got it. Okay. Very, very cool. So this is at the end of the podcast here, I have sort of a send-off question. But I'm going to run this send-off question a bit differently. Since you're a tax expert, I want to ask you a tax-related question. Are there any tax hacks, as funny as that sounds, tax hacks? Are there any tax hacks that you can think of to help someone meaningfully save money when it comes to paying Uncle Sam this year?
Any tax hacks? Well, I mean, the Roth IRA is one of my favorite tools. I mean, you've already talked about that, but I can never talk about the Roth IRA enough. A common strategy that people use is if your income is over the allowable thresholds for the Roth IRA. So let's say you're a married couple and your income's well over $200,000, then you're not able to contribute to a Roth IRA directly. So what you could do is that you could make a traditional IRA contribution after tax and convert that immediately over to a Roth, and that is known as a backdoor Roth IRA contribution. And actually, well, we touched on some proposals in that Build Back Better plan. So this is actually a strategy that the government is looking to eliminate. But but they weren't able to pass that Build Back Better plan. So the backdoor Roth IRA still exists. Now, one major point of caution is that this works best for people who have no other existing traditional SEP or simple IRAs, as they're able to do this with the least amount of taxes, in that type of scenario.
Got it. Got it. Very cool. I learned a lot. You didn't learn anything because you taught me everything, but this is incredible. I learned a lot, and I think that the people listening to this would agree that they've probably learned something as well. Eric, you're an absolute rock star. Thank you so much again for joining me. And before we hop off here, is there anything else that you want to add, or maybe a place where people can find you or learn more information about stuff that you perhaps have published or have participated in?
One of the exciting things that I've worked on recently is I did a live tax chat with the Washington Post where I answered reader tax questions, and it's something I really enjoy doing because I'm able to basically speak directly to the average American and understand the kind of issues that they're facing right now. And sometimes I'm able to provide them with some solutions that make their lives a little bit better off.
Got it. So I will actually include. I'll find that. I'll just ask you for the link for it, but I'll find that and I'll include the link to that in the show notes here, so people who are listening to this podcast can go in, click that, and watch you. Assuming they can watch it, answer those questions with the Washington Post.
It's all actually text based, but
okay.
No. And I'm also looking to do another one pretty soon too. So I've done it probably 10 times over the last 4 years or so, somewhere in that area. So I would hope that I'm going to be doing it again in the near future.
Sounds good, man. Well, I love it. Thanks again for joining us, Eric.
It's my pleasure. I'm really happy to be here, and I think that I've really enjoyed the opportunity to connect with the listeners.
100%. See you, man. Bye.